Welcome to another episode of Decode with Mithun, Stock Market Analysis.
Today, we're going to peel back the curtain on the super fast-paced world of intraday stock market trading. We're going to break down how the pros make sense of all that noise and actually find opportunities. Let's dive right in. So picture this. The opening bell rings, and the Nifty 50 index just tanks. It's down 110 points right out of the gate. For most people, that's pure chaos, right? A signal to run for the hills. But for a professional trader, this is where the real work starts. So the question is, how do they look at this mess and see a clear, calculated plan? All right, so here's how we're going to break it all down. We'll start with the opening bell and that critical line in the sand. Then, we'll decode the map traders use to navigate. We'll get into two really cool trading theories, the magnet and the trap. Then we'll see a trade go down live in just minutes. And finally, we'll zoom out to see the bigger picture and really understand why any of this matters to you. Okay, so the market opens and bam, the fight is on. And you got to understand, this isn't just random selling. This is a targeted battle happening at a very specific, very important price level. The magic number for the day is 24,464. Now, for months, this level has been like a fortress wall. It just has not broken. But today, the sellers are right at the gates, trying to tear it down. This one price point, that's the battlefield for the entire day. So how do traders actually see this battlefield? Well, they're not just guessing. They use a kind of map. And in trading, one of the best maps out there is something called the option chain. It's basically a data snapshot that tells you exactly where the big money is placing its bets. Now, the people who draw the lines on this map are called option writers. These are usually the big fish, large institutions. And here's the interesting part. They're not betting on where the market will go. They're betting on where it won't go. They sell these options, collect a fee, and in doing so, they basically get paid to draw these lines in the sand for everyone else to see. And this brings us to the two opposing armies in this fight. On one side, you have the call writers. Think of them as the bears. They've sold call options, making a bet that the market's going to hit a ceiling and won't go any higher. They create what's called resistance. On the other side, you've got the put writers, the bulls. They've sold put options, betting the market has a floor and won't drop any further. They create support. And this brings us to the hard data around that key psychological number, 24,500. We're looking at what's called open interest, or OI, which is just the number of open contracts. And wow, just look at how lopsided this is. The call writers, the bears, have 3.4 crore positions open. That's a massive wall of sellers. Meanwhile, the put writers, the bulls, they only have 1.9 crore. The bears outnumber the bulls here by almost 2 to 1. And this chart just makes that power imbalance crystal clear. I mean, look at that. That huge orange bar, that's the bearish call writers. They have built an absolute fortress at 24,500, and all that weight is pushing the market down. The bulls, that smaller bar next to it, are clearly on the defense. Okay, so you have the data. Now what? Well, traders use this data to apply theories, kind of like a playbook, to figure out what's likely to happen next. And on this particular day, two theories were front and center: the magnet theory and the trap theory. Early on, with these huge armies of call and put writers duking it out over 24,500, the magnet theory kicked in. The price literally gets pinned. It can't really move up or down because of this intense gravitational pull from both sides. It's like it's stuck to a giant financial magnet. You get a stalemate. But, stalemates in the market, they never last forever. I love this quote from our source material because it's the perfect analogy for what happens next. Just imagine all that pressure from the bulls and the bears building up behind that price level, like water behind a giant dam. It holds, and then it breaks. And when it does, the flood is just massive. And this is what's known as the trap theory. The whole idea is to wait for one side to get trapped. So when a massive selling order comes in and just completely overwhelms the put writers at their support level, that dam breaks. Now, to stop losing money, those trapped riders have to bail on their positions. That means they have to sell, which adds even more selling pressure, and you get this incredible cascading price drop. It's a chain reaction. And at 11:15 in the morning, that is exactly what happened. The stalemate was over, the trap was sprung, and the market finally made its big move. So let's see how this theory actually turned into a real live trade. So how do you go from theory to actual profit? Let's walk through it. First, you have the setup. The market's already weak, struggling under that huge wall of resistance at 24,500. Second, you get the trigger. A huge bulk order to sell smashes into the market, and it breaks that critical support at 24,460. The dam breaks. Third, the entry. Seeing this, traders jump in and buy put options. In this case, the 24,500 put for about $55, betting that this flood is just getting started. And just look how fast this happens. It's mind-boggling. At 11:15 a.m., the support level cracks. Just 1 minute later, 60 seconds, the price of that put option has shot up from 55 to over 85. Why? Because all those trapped put writers are scrambling to get out. By 11:20 a.m., less than 5 minutes after it all started, traders are already cashing out, booking around a 50% profit. That is a textbook execution of the trap theory. Now, if you only saw that 5-minute trade, you would think the market was an absolute free fall, right? That the sky was falling. But this is why it is so important to zoom out and see how this one dramatic moment fits into the bigger story of the day. And here is the twist in the tale. After that terrifying drop, the buyers came roaring back. The market pulled off a perfect V-shaped recovery, clawing its way all the way back up. And incredibly, it actually closed the day above that same critical support level that had been shattered earlier. The fortress wall was breached, but by the end of the day, the bulls had already rebuilt it. So, what's this mean for the next day's trading? Well, today's chaos actually creates tomorrow's clarity. That low point of the day, that's now a new, confirmed, and super strong support zone. That V-shaped recovery,
Welcome to the deep dive. Today, we're really unpacking a pivotal market session, August 7th, 2025, for the Indian market.
Yeah, quite a day.
Our mission here is simple. Extract the key insights from that, well, really dramatic day. You had that big initial dip, then this amazing V-shaped recovery.
Absolutely.
We want to help you quickly grasp what happened and what it might mean going forward.
It was fascinating, wasn't it?
Yeah.
Really showed how fast market mood can swing. We'll dig into how those crucial support levels were, tested and ultimately held up.
And the psychology behind it all.
Exactly. How that played out in the options data, that intricate dance. And importantly, what this big turnaround could signal for the next few sessions. Should be insightful.
Okay, let's dive in then. August 7th. How did it actually, unfold? Nifty opened down, big gap down, 110 points.
Yeah, landed right at 244.64.
And that number, 24464, that wasn't random. It's been a key support level held since May, right?
Precisely. So the big question right at the open was, is this floor going to hold? Is this multi-month support finally going to give way?
And what was really interesting, you could see it straight away in the option chain. That became the immediate battleground. How so? Well, we saw a big jump in activity, both put writing and call writing, especially around that 24,500 strike price.
Right, put and call writing, basically bets for or against certain price levels.
Exactly. And when you get a lot of aggressive writing like that, it often creates what we sometimes call the magnet theory.
The magnet theory, explain that a bit.
It's this idea that high volumes of options
Written at a certain strike price can sort of pin the market, pull it towards that level, makes it harder for the index to move decisively away, up or down. It gets sticky.
Okay, so the market...
460 and then dip below it briefly.
Strategies had to shift fast.
Instantly. You had to adapt whether you were playing the initial fall or positioning for that eventual rebound. Very dynamic.
And it wasn't just the index level itself. The big sectors played a role too, I imagine. The banks.
Oh, definitely. Initially, in the morning dip, the banking majors like HDFC Bank, ICICI Bank, they were adding to the pressure. But later in the day, they showed real strength. They recovered. And that provided crucial support for Nifty's big comeback.
It really highlights the discipline needed on a day like that, doesn't it? Watching those levels, managing risks.
Absolutely crucial. And the sources we looked at, they actually detailed several profitable options trades that were spotted and executed.
Oh, interesting.
Example. Yeah, like there's a 24,400 call option. It apparently went from about 25 points all the way up to 193. Huge move.
Wow.
And on the other side, during the volatile swings, a 24,500 put apparently rallied from 40 points up to 140 at one point.
So opportunities on both sides, if you timed it right.
If you timed it right and managed the trade, it really drives home the importance of, solid analysis, but also strict risk management things like using trailing stop losses, knowing your entry points clearly. It's not just about placing the bet. It's about navigating the storm.
Okay, so that brings us to the recovery. A powerful V shape, closing strong, leaving a bullish hammer candlestick on the daily chart. That's a pretty positive signal, technically speaking.
It is. It often signals a potential reversal after a sharp decline.
So after all that drama, what's the game plan looking like for Friday, August 8th? What should we be watching for?
Well, if you look at the chart, Nifty's still operating within this broader downtrend line.
Yeah.
But that recovery definitely adds a bullish flavor.
Right.
So for potential upside, the key level to watch is Thursday's high, around 24,640. If Nifty can break above that, especially if it consolidates a bit first, maybe between 24,600 and 640.
Then we could see a further move up.
Yeah, the next potential targets could stretch up towards 204,850.
Okay. And the flip side, downside risks.
On the downside, the immediate support zone is around 24540 to 244,550. If that area breaks, then 24,500 comes back into focus.
And below that,
There's quite strong support expected around the 24,300 to 240,50 zone. That held up well before.
got it. And quickly, what about the broader market? Sensex, Bank Nifty, any key levels there for Friday?
For Sensex, resistance seems to be around 81,500 to 81,600. Support might come in below 8,400 if it heads lower.
Okay.
For Bank Nifty, a break above
55600 could open the door towards 55250. But if it slips below 55250, then look towards 55150 and maybe even 55000.
And a word of caution for Friday trading.
renewed worries about Trump's tariffs adding to the early pressure and then rally so strongly, almost against the tide.
Yeah, it just underscores, again, the need for dynamic analysis, for strategies that can adapt on the fly. Which leads to the final thought for you, our listener.
Oh, on.
Given how Thursday unfolded, what unexpected turns, what market surprises might shape your decisions next? Something to think about.